trading friends, and welcome back to Forex Focus, brought to you by tastyfx. We're going to dig into the Japanese yen crash continuing here through the middle part of 2024. If you thought the last couple of years was bad, Japanese yen is looking for some new lows in recent trade. We're going to cover the price action, the historic price action as well, because this is quite a historic level that yen is hitting, not only against US dollar, but euro and a number of other major currencies. But we're also going to go deep on why it is that this is happening. Why is this yen getting weaker? What has to happen for it to pick itself back up? As well as, how much worse could it get? And we'll conclude today's show with showing you the current sentiment from Forex traders in the dollar-yen market. You might be surprised by where they're positioned given this recent move. But let's get into the move itself, because it's been a rough last month or so here as the dollar-yen market is up about 300 pips in June itself. And then you go back to May and you see the lows for dollar. They're around the 150 to 155 range, and now you see this market climbing towards 160. I mean, that's a monster move in the last couple of months here. You'd be hard pressed to find a euro dollar market or a pound dollar CAD market that moves a couple hundred pips in a month or so. This market here moving hundreds of pips every month, it seems, become one of the most volatile Forex markets dollar yen has. And like I said at the start, it hasn't just been the dollar. We're not digging into the euro yen market or the sterling yen market, but take a look at those as well, because those European currencies are also starting to beat up on this Japanese yen, as well as it hasn't just been US strength. It's been a lot of Japanese weakness. But yeah, it's been bearish here in recent months, getting back to that 160 level that, as we dig into the historical price action, you'll see is a very important level. This is the highest price for dollar, lowest price for yen in this Forex pair since 1990. And even going back to the early 90s, you can see that this market just barely gets up to 160, touches it, and then gets hammered for the rest of the 90s there, all the way down to double digits. And you can see over the last 30 years, double digits isn't, a rare sight. There's been a lot of trading in that 80 and 90 handle, but the long-term average closer to 110 or 120. Either way, thousands of pips away from where we're trading the weakest price for yen in the last 30 years plus. We'll see if they take out this 160, as we just saw in the short-term price action. They're headed for it. I mean, in June alone, it was a straight shot from 155 to 160. And now you can see with the wider lens just how crazy and significant a price level that is. And now with the background of the price action in this dollar-yen pair, and like I said, it's not all on the dollar. In the last couple of years, we've seen a lot of the price action in this pair being on that dollar front, because the U.S. was one of the first major economies to hike interest rates. They hiked the furthest of the major economies. And so there was a lot of dollar strength in 2021 and 2022. You saw that euro dollar market break parity in the last couple of years. But now euro dollar is back at 107, 108, relatively normal prices. The pound is back above 1.25, and it got down to 105 at its lowest. So what's going on with this yen piece? Why is Japan still so relatively weak, especially compared to the major currencies like the dollar, like the euro, and like the pound? Well, we're always going to start with the interest rate piece when we're talking about currencies and we're talking about forex trading, because this at a very core level is so essential to supply and demand dynamics in currency markets. Because when you're trading forex and you're long US dollar and the Fed has interest rates above 5%, and you're short Japanese yen, and the Bank of Japan has interest rates in negative territory for the last couple of years. They just recently in March hiked for the first time since 2007, and they only got back to 0% interest rates. Well, if I'm long that dollar, I'm actually getting paid overnight that 5% plus, of course, brought in for just one day, or depending if you're holding it for over the weekend. I'm getting that 5% plus interest rate on my long dollar piece, and I'm short that Japanese yen, and so I'm paying 0%. Now, of course, forex brokers will have a small admin fee in there, but again, the supply and demand dynamics in terms of interest rates between the U.S. and Japan, or the euro area, they've been around 4.5% the last couple of years, and the UK have been around 5% as well. You're going to see a lot of demand for those currencies with higher interest rates, and not so much demand for the Japanese currency, which has been hard to get out of even negative territory. I think it would be very, very uncontested to say that the Bank of Japan has been the most accommodative, the most dovish central bank of the major central banks in the 21st century. I mean, you really have to go back to the 70s and 80s to find interest rates north of 2 or 3%. And then even by the mid 90s, they had fallen into this rounding error off of 0%, which, say what you will about the Fed or about the Bank of England or the European Central Bank, they've been able to get to 1.5%, 2% prior to this most recent run, and on this most recent run, get above 4 or even 5%. And now the next piece that I want to rope in, I just want you to keep in mind this 70s and 80s area there when interest rates were higher, because you're going to see a similar trend with the GDP growth rate here out of Japan, which is we haven't seen high GDP out of this Japanese economy since that same time frame. You have to look all the way to the left and see the data points in the 80s where you're seeing GDP growth rates of 2-3% consistently. I know you see that spike there in 2020, but that's only for 1 or 2 quarters, and that's coming right out of the pandemic where you saw historically negative GDP, and everybody, every major economy saw that huge drop off the first couple quarters of 2020, and then a huge spike following it. But you look to the right of that spike, and I'm talking about the last 2 or 3 years, and you're seeing not a lot of growth there GDP-wise, and you're seeing a handful of negative prints, and you just didn't see that type of low growth and even negative growth in the US, in the UK, in the euro area, as you did here in Japan. And this is also to say, look throughout the aughts and the 2010s, man, they just couldn't stack together a lot of consistently high GDP growth in any of these decades. And so you pair this weak economy with this low interest rate environment, and it becomes kind of a never-ending cycle, right? Because it's like, well, we're not confident enough to raise interest rates because we're not seeing GDP growth rates in consistently positive territory, whereas the U.S. saw that consistent growth coming out of the pandemic, and of course they saw that high inflation, and so they could and had to raise interest rates coming out of that. Japan not able to lift its currency's value, or at least contend with the demand of other foreign currencies, because its economy didn't really get kickstarted in the same way that parts of Europe and the US did. Another piece, kind of the kicker on this conversation, is the balance sheet out of Japan. And this is kind of the last two slides put together in a way, which is to say, the balance sheet continues to expand here in Japan, where in the same time from the highs that the U.S.'s balance sheet, the U.S. Fed's balance sheet saw coming out of the pandemic, they've actually been able to shrink their balance sheet by more than $1 trillion, and has been moving lower in the last year or two. Japan continues to move higher, and so when the rest of these global economies have been able to put forward contractionary policy with higher interest rates and shrink their balance sheet, Japan hasn't been able to do either of those things because they're not seeing the economic growth there. And you might say, well, the Japanese stock market, the Nikkei, is at all-time highs. Well, yeah, part of the problem there is that the Japanese central bank, not shrinking its balance sheet, continues to buy assets like ETFs. And so when you turn that off, what happens to what a lot of people might say is a very vulnerable Japanese economy, not seeing the GDP growth, and a Nikkei that's at, all-time highs, but it's not the same all-time highs as the S&P 500, whereby the U.S. central bank has been shrinking its balance sheet in the last couple of years, and the S&P has still been able to hit all-time highs. Bank of Japan has actually continued to expand its balance sheet since the pandemic and since when most other major economies saw highs for this expansionary policy. And so again, all these pieces kind of working together in what has been a perfect storm of bearishness. So let's see where traders are positioned on this major forex pair, because it's actually a little surprising. Obviously, the price action has been pointing in the long US dollar, short Japanese yen direction. But when we're looking at forex traders here at IG Group and including tastyfx here in the US, we're actually seeing overwhelmingly short sentiment from these forex traders, as it seems like a lot of people on the side of historic potential mean reversion. And what I mean by that is, like I talked about a little bit when we looked at the last 30 years of price action, this is a market that has hit 155 and hit 160 in the past and has moved all the way back down to the 110, 100, and even double digits range historically. And so it seems like a lot of the retail forex trading crowd looking for that mean reversion at some point. Now, of course, there's huge risk to that, and there's been a lot of pain to that in the last couple of months as this market went to 150 and then went to 155 and is now brushing up against those 30-year highs of 160. The market doesn't necessarily have to mean revert, though it has historically. But also, even if it does mean revert, it can go from 160 to 165 before coming down to that 110 to 120 range. So keep in mind, anything on the table that we are seeing, 4 out of 5 traders in this market short this US dollar, long Japanese yen, even at these lows for that yen. We'll continue to monitor all of this economic data and, of course, the price action. Thanks for watching.